What's up guys, it's Adam here coming at you with another video, except this time it'll be about investing and specifically what to do when everyone else is freaking out and what the intelligent investor says about this. Over the past few days there's been a lot of news and uncertainty on social media about what's going on in the economy right now. A lot of people have been saying there's a huge economic collapse happening, there's insolvency issues, there's a debt crisis, move all your money into Bitcoin, and so on. Who knows? They could be right. All I know is that I can't predict the future, and there seems to be hundreds of people out there who have either a time machine or a crystal ball telling them what to do and what's going to happen.
Don't touch it, it's Uncle Rico's.
What's it for?
It's a time machine, Napoleon. We bought it online.
This is why I really need your help. If you happen to know a crystal ball or time machine dealer, I'd really like to get in contact with one. I think the ability to tell the future would be amazing, and I could, it has a lot of implications for the rest of my life. So just please leave a comment or send me an email. It'd be much appreciated. In this video, we're going to go over a perspective on what's going on in the economy right now from a fundamental point of view, along with the idea of the difference between investing and speculating and what the intelligent investor has to say about this. And also what you can do right now to create wealth in the long term by taking advantage of fear and volatility. If you want more content like this, please like and subscribe. I'll work on getting a more suitable camera and lens and even a microphone so my videos won't be as crappy. But I've got a lot of positive feedback so far, so I think some of you have been finding value in the content I've produced. So, whether you have kept up with or ignored all of the activity that's been going on in the news for the past 4 months, let me fill you in. There's been record unemployment as of late, GDP has been declining, there have been huge fiscal deficits from government spending, negative oil prices, and TikTok is becoming way too popular. However, if you bought into the market about 1 month from the time of filming this video, you'd be up about 13%. And if you were lucky enough to time the stock market dip perfectly in March, you'd be up around 26 to 27%. And finally, last month, stocks closed out their best monthly gain since 1987. So the question is, why is the stock market going up when there's so much negative news? And why is there so much speculation around this? Who do you believe? We could go into this in an entirely different video, but it comes down to something called the efficient market hypothesis, which was created by this sexy guy, Eugene Fama. I'm not going to go into it in detail, but the efficient market hypothesis states that stock prices immediately reflect all current information available. Now, I don't know if this hypothesis is true or not because it's kind of controversial. However, I feel like there's some elements of it that are realistic and believable. It's really important to understand this principle when people refer to the market as almost as if it's a living entity that can breathe or react or make decisions for itself. Some investors right now believe that the market has already factored in all of this negative news and is now looking forward to the future. Right now, they're pricing in the fact that governments all around the world will do whatever it takes to stop the global economy from collapsing. Here in the US, the Federal Reserve has done this through heavy quantitative easing, which means money printing in the form of buying securities from banks that injects liquidity in the system. You may have heard that interest rates are close to zero or practically 0%. That's what quantitative easing is. The government is making, not the government, but the Federal Reserve is making money as cheap as possible so that way we don't strain banks, businesses, and other financial institutions. In addition, the federal government will continue to implement drastic fiscal policy to keep businesses and sentiment alive. One good example of this is through stimulus checks, and it seems like almost every week there's been debates in the government about the effect of stimulus, further stimulus that they plan to implement, and we all know the trillions of dollars our government is borrowing and spending to be able to do this. A great example of governments promising not to let the global economy fail is from a statement that the Federal Reserve made 1 or 2 weeks ago. Here it is. The Federal Reserve's response is guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the safety of the financial system. We are also committed to using our full range of tools to support the economy in this challenging time. The market always anticipates. And right now, the market is anticipating positive future news to be coming out in the near term. Another great example of this is recent news about Donald Trump reopening the economy and other nations following suit. Some states are already open at this moment. There's also the flattening curve of infections. However, at the same time, there's kind of controversy on that end because people believe that the infection curve will increase as we reopen. But I think the fact of the matter is, and most people would agree on this, that there's a lot of positive economic news that could be coming out in the short term that would increase expectations. And because of all of this, people need to understand that the stock market is not the economy. You need to understand this. The stock market is not the economy. Instead of macroeconomic factors that affect the economy like GDP, unemployment, inflation, the stock market is affected by human emotion and psychology. Yes, economic indicators do have bearing on the stock market, but really, the stock market is just individuals like you and I buying and selling equity to each other. And sometimes we buy and sell not based on facts, but based out of emotion. These emotions can skew the market out of balance sometimes. And in reality, this presents the opposite argument to the efficient market hypothesis in the sense that the market is not always efficient. So what do you guys do? What do you do when there's so much contradictory information out there and adverse opinions about what's happening in the market right now? Because a lot of times, most investors get tricked by this and make bad decisions with their hard-earned money. Emotional, irrational decisions. And one of the first rules in investing is to always make rational decisions. Although I don't have a crystal ball and I don't know what the future holds, there is a few things I've learned. One thing that I've noticed is that US Treasury bond yields are at their all-time lows. So why is this important? US Treasury bonds are considered one of the safest investments in the world. In fact, US Treasury bonds are often attributed to being the same as cash. US Treasury bonds are a promise to the buyer of said bond that they will receive a payment in US dollars coupled with a fixed coupon payment at the time of the maturity date of the bond. These bonds are considered risk-free for a lot of different reasons. One is that the US government has never defaulted on its debt, and two, the US Treasury is protected by every single nuclear missile in its arsenal. Without boring you on details about how bonds, the Treasury Department, and the Fed works, you could buy a 30-year Treasury bond at around a 1.3% yield today. That is a terrible investment. Why? Because the Fed's target rate of inflation is around 2% a year. At a guaranteed 1.3% return on investment, you would lose it to inflation every year on average. So I'll ask you this, where do you think people are putting their money now that yields in bonds are so low? Are they going to put it under their mattress? Are they going to put it into Bitcoin because fiat currency is dead and that the US dollar will eventually be worthless? Are they going to put it in their shoe? No. No, they're not. They're going to put it in the stock market because that's what smart people do. They're going to put it in the stock market to protect them from inflation and create earnings from growth in companies. So now you might ask, okay Adam, well, what do I invest in? How do I make smart decisions when there's so much craziness out there and so much crap going on? And this leads me to my next point. The difference between an investor and a speculator. I'm going to have to paraphrase our friend Benjamin Graham on this. An investor calculates what a stock is worth based on its value. A speculator gambles that a price of a stock will go up because they think somebody else will eventually pay more for it. Investors judge market price by established standards of value. Speculators base their standard of value on market price. Now what does that crazy Yoda, Gandhi stuff, words of wisdom even mean? You should only invest in the stock if you'd feel comfortable buying it and then not knowing what its price is for like 30 years. Like casino gambling, speculating in the market can be exciting and even rewarding. I've done it plenty of times, but it is the worst way possible to build your wealth. That's because Wall Street, like Vegas, has the odds fixed in the house's favor. Anyone that tries to beat the house against its own speculative game in the long run will lose due to the law of averages. On the other hand, investing is its own unique form of casino. It's one where the odds are in your favor, but they're only in favor so long as you play by the rules of investing. At the end of the day, people who invest make money for themselves, people who speculate make money for other people. And that is why Wall Street always downplays the virtues of investing and overhyped speculating and the hot new IPOs and the crazy products that companies have come out, or the Teslas or the Beyond Meats of the world, or whatever. Crazy hot companies that are risky investments are way more sexy than buying a company like Coca-Cola. The intelligent investor never dumps a price just because the share price has fallen. He or she first evaluates what has changed within the business model. If the value of the underlying company has changed, they reflect and then make a decision whether to sell or not. Most of the time, if you're buying the right companies at the right prices, the market has just mispriced the stock, and you can take advantage of the volatility and simply buy more, even if the stock price falls 50, 70, 80, 90%. In a way, we'll all have to speculate eventually, but the core truth, the unshaken doctrine, is that be an investor, not a speculator. And in the words of Benjamin Graham, an investment operation is one which, upon thorough analysis, promises the safety of principal and an adequate return. So, to answer the question, Adam, where should I put my money? Adam, where should I invest? I can't teach you how to invest in this video, but I plan on doing so in the future. But keep to these 3 points. 1. You must thoroughly analyze a company and the soundness of its underlying business before you buy its stock. 2. You must deliberately protect yourself against serious losses. And 3. You must aspire to adequate, not extraordinary performance, which really means any return that you are willing to accept. So then you might ask me, well, Adam, I may not know everything, so what are you going to do, since it seems like you have more experience? Well, yes I do, but I'm no genius. I put money in the market last week, the week before that, the week before that, and the week before that. And my plan is to continue putting in the market every single week for the next 6 months. I'm going to ignore the news, I'm going to ignore speculation, and I'm going to stick to core investing principles. I was telling my friend the other day that my portfolio right now is way higher than it was before the crash even happened, because I wasn't greedy and had lots of cash. That rhymed. Always ask yourself, what are the fundamentals of the asset you're buying? What are the yields, and are you happy with that? That's it. That's all you should do. If you buy a great business at a great price, you'll be able to sleep at night and not worry. Buy a business with great cash flows, low risk of insolvency, and long-term growth prospects, and a history of paying a good dividend. You won't care what happens in the short term, because if the stock goes down by 50%, and as long as the fundamental business hasn't changed, you'll buy more. You'll be excited when the stock goes down because it's an opportunity to create more wealth for yourself. Why am I not selling everything right now? Because honestly, I don't know if a crash will happen. It very well could be, and if that happens, that's a risk I'm willing to take. Unlike all these other YouTubers with crystal balls, I don't know what will happen. Selling now and trying to time a crash is much more risky for me than it would be to just stay invested and buy good businesses. When I see something that will increase my wealth in the long run, I buy it, sit back, and watch it pay me dividends. Remember guys, be fearful when others are greedy, and greedy when others are fearful. That's all I've got for today guys. Please let me know if you have any questions in the comments below. I'd be happy to answer them. In future videos I'm going to go through how I analyze a stock, how I invest, how to even create a stock portfolio, and where to sign up for a brokerage. Just let me know what you want and I'll deliver. Until then, make sure you pay off your credit cards.